Ever felt like you're just drowning in numbers when you look at a financial report? That dense stack of figures, and you're just wishing someone could point out what really matters.
Yeah, it happens a lot. Navigating quarterly results can feel, well, like a bit of a maze sometimes.
Exactly. But that's what we're here for.
Consider this deep dive your strategic shortcut. We'll cut through the jargon, try to connect the dots, and pull out the interesting bits, the surprising facts, just for you.
Absolutely. So today we're diving into the recent Q1 FY26 results from Jana Small Finance Bank. They're a really interesting player, becoming quite key in India's small finance bank sector.
Definitely one to watch.
Our mission here is to unpack their core performance, look at their strategic moves, and figure out what these numbers really tell us about where the bank's heading.
And crucially, what these trends might mean for your understanding of a bigger picture economic shifts, banking insights, that sort of thing.
Okay then, let's get into it. Let's unpack this. So starting off, the headline from Jana Small Finance Bank. It sounds pretty standard, right? Resilient performance in Q1 with positive traction in key levers.
Yeah, typical corporate speak sometimes.
But then you look at their reported profit after tax, the PET, for Q1 FY26. It came in at 102 crores. Now, compare that. It was 171 crores same time last year, Q1 FY25, and even 123 crores just last quarter, Q4 FY25. So just looking at that, you might think, what's going on?
You absolutely would if you stopped right there. But here's where it gets interesting, the real twist.
Okay.
That 102 crores reported PAT for Q1, it actually includes a pretty big accelerated provision. They deliberately set aside 150 crores this quarter.
Ah, okay. A provision of 150 crores. So if we sort of adjust for that, adding it back, and also accounting for deferred tax assets, what does the picture look like then?
Well, the adjusted PT, as they call it, it climbs right up to 252 crores for Q1 FY26.
252 crores.
Yeah, and that's actually an 18% increase over the adjusted PT from Q1 last year.
So it flips the narrative completely. And this isn't just like some accounting gimmick.
Not at all. Think of it more like they're deliberately strengthening their foundations. This proactive provisioning, it helps them keep their net NPAs, net non-performing assets, consistently below that 1% mark.
Right.
So for you watching this, it signals a really cautious, stable approach to managing risk. They're prioritizing long-term health, maybe over a shinier number this quarter.
That makes sense. It's a sign of confidence in their own book, really.
Exactly, a strong signal.
Okay, moving on from the bottom line, let's talk core earnings. Net interest income, NII. How did that look?
NII for Q1 FY26 was 595 crores, relatively stable compared to recent quarters, actually.
Okay, and the margin, net interest margin, NIM.
That came in at 6.9% for the quarter.
6.9%. We did see a bit of a dip there. It was 8.0% back in Q1 FY25. What's your read on that margin compression?
Well, it's the trend we're seeing across the board, really, with the rising cost of funds impacting everyone. But what's interesting here is the management's commentary. The MD and CEO, Mr. Ajay Kanwal, he specifically mentioned they expect the cost of funds to reduce further in the upcoming quarters.
Oh, okay.
And he expects that to lead to an improvement in net interest margins. So it suggests they have a plan. They're not just, reacting.
That's a crucial bit of forward guidance. Okay, beyond the core lending business, what about other income streams? Any diversification happening?
Definitely. Other income actually showed very strong performance. It grew to 266 crores in Q1 FY26.
Nice. What's driving that?
The main bits were commission, exchange, and brokerage that brought in 169 crores. Then profit on sale of investments was 49 crores, and another 49 crores came from miscellaneous income.
Miscellaneous? What falls under that?
That includes things like income from selling priority sector lending certificates, PSLCs, and also recoveries on bad loans.
Ah, PSLCs. Now, I think I remember reading something. Wasn't there a change in how they account for those? Does that affect the comparison?
You're absolutely right to flag that. Yes, there was an accounting policy change. It's really important for comparing quarter to quarter.
How so?
Well, basically, only 18 crores from PSLC sales were recognized upfront in Q1. The rest is being amortized, spread out over time.
Okay.
So if you just compare this quarter's other income number to previous ones without knowing that, you might misinterpret it. They're smoothing the income, essentially.
Okay, that's a critical detail. It really highlights why you need to dig deeper than the headline numbers. So what about efficiency? Cost to income ratio.
The reported cost-income ratio for Q1 FY26 was 65.4%.
Seems a bit high.
Well, again, context is key. The source mentions that the same accounting policy change we just discussed also impacted this ratio, pushing the reported number higher.
Ah, okay.
On a like-for-like basis, trying to get a truer operational picture, the cost-to-income ratio is actually closer to 61.7%.
61.7%. That sounds more efficient.
It shows they are managing costs reasonably well, even while they're investing in growth and technology, which is, pretty crucial.
Speaking of growth, let's shift gears to their loan book. Total assets under management, AUM.
Stands at 29,930 crores. That's up 16% year on year.
16%. How does that compare to the rest of the sector?
Favorably, the overall banking sector growth was around 9.5% year on year during the same period, so they're definitely outpacing the average.
But growth isn't everything, right? What about the type of growth?
Exactly. And that's probably the biggest story here. There's a major strategic shift happening towards secured assets.
Secured lending. Okay.
These secured loans now make up 71% of their entire loan book. That's a big jump from 62% just a year ago in Q1 FY25.
Wow, 71%.
And growth in these secured assets was strong, up 36% year on year if you exclude loans against fixed deposits.
So conversely, what's happening with unsecured loans?
Those actually saw degrowth, down 12% year on year. They're actively shrinking that part of the portfolio.
So this clear pivot towards secured lending loans backed by collateral like property or gold,
Yeah.
what does that signal for the bank's risk profile? And for you, the listener?
It typically signals a more conservative stance, a move towards a stabler risk profile. They're prioritizing asset quality, building resilience, maybe sacrificing some higher yield from unsecured for more safety. For you, it suggests a bank building a stronger, perhaps more predictable foundation.
Makes sense. Within that growing secured part of the book, are any particular areas really driving the momentum?
Yeah, they highlighted some strong quarter-on-quarter growth numbers in specific segments. Gold loans surged by 29%.
29%.
Yeah. Two-wheeler loans were up 14%, and affordable housing grew by 6.5%.
So targeted growth in key areas.
Exactly. It shows where they see opportunity and demand, especially in what they call aspirational India.
Okay, all this lending growth needs funding. Let's talk deposits. How are they doing on that side?
Just as strong, maybe even stronger. Total deposits hit 29,426 crores. That's up a solid 24% year on year.
24%. Again, how does that stack up?
Again, significantly outpacing the sector. Average deposit growth for banks was around 10% in that period.
And the books. CISA versus term deposits.
KSA, the cheaper current account savings account deposits, grew 8% year on year to 5,233 crores. Term deposits grew much faster, up 28% year on year.
Okay. And what does this mean for their overall liquidity position?
It's improving things. Their credit-to-deposit ratio, the CD ratio, came down to 94.6% in Q1 FY26. It was over 100% at 102.1% a year ago.
So deposits are growing faster than loans now.
Precisely. Which is healthy. And if you exclude refinance facilities, that CD ratio looks even better, down at 83.9%.
And their liquidity coverage ratio, LCR.
Very strong, 171%. It indicates they have plenty of high-quality liquid assets to cover any short-term needs. No liquidity concerns there.
And they're not just passively collecting deposits, are they? I saw mentions of new products.
Right. They launched things like the Solitaire Savings Account specifically for women and also introduced the ASBA facility, which helps people apply for IPOs and things.
So it's not just about getting funds.
No, it's about deepening relationships, targeting specific customer groups, using convenience and digital tools to really build that deposit base strategically.
Okay, let's get into the real nitty-gritty now. Asset quality and capital health, NPAs.
Gross NPAs stood at 2.8%, and the important one, net NPAs, was at 0.9%.
0.9%. That ties back directly to that big provision they took, doesn't it?
Exactly. It shows that provisioning was effective in keeping net bad loans very low. And the provision coverage ratio, PCR, is also strong, 82.2%, even including technical write-offs. It shows they're well covered for potential losses.
A solid position then.
Very sound. And just a small note on unsecured, even though they're shrinking it, about 36% of their microfinance book is actually covered under guarantee programs, which adds another layer of risk mitigation.
Good point. And finally, on health checks, their capital buffer, the capital adequacy ratio, CAR.
It stands at a very robust 20.5%, and that includes the interim profits from Q1 FY26.
20.5%. What does that tell us about their ability to grow further?
It tells us they have an excellent capital buffer, way above the regulatory minimums. For you, it means they have a strong cushion for unexpected shocks, and, importantly, plenty of firepower to support their future growth ambitions without necessarily needing to raise fresh capital right away. It's a really solid foundation.
Now let's talk strategy and vision because there's some really fascinating stuff happening there.
Yeah.
During Q1, Jana Small Finance Bank actually filed its application for a universal bank license with the RBI.
Yes.
That's not just a small adjustment, is it? That feels like a major strategic move.
Oh, it's huge. It's a game changer. It signals ambitions far beyond just being a small finance bank. They want to play in the big leagues, compete more directly with larger commercial banks, offer a much wider range of
It
services.
suggests a lot of confidence for management.
Absolutely. It implies they believe they have the operational muscle, the technology, and the capital base to make that leap.
And their management commentary seems to back that up. Mr. Kanwal highlighted strong macro fundamentals in India, seeing accelerated opportunities in their core areas like housing, rural lending, MSME finance.
Right, and those are exactly the areas poised for growth in the Indian economy. He also pointed to things like potential CRR reductions, repo rate cuts, and of course, surging digital adoption as positive factors.
So favorable tailwinds for them.
Very much so. It creates a really positive operating environment, especially for a bank like Jana that's already deeply embedded in these growth segments and is clearly very strong digitally.
Speaking of digital, they got a pretty significant award, didn't they?
They did. They actually ranked first among small finance banks for digital payments performance at the Digital Payments Awards 2023-24.
Yeah.
That's organized by the Ministry of Finance, so it's a serious recognition.
And the internal numbers reflect that commitment.
Completely. Get this. 98% of their banking transactions are digital. 99% of their loans are digitally processed. And 99% of their sales team use tablets or mobiles out in the field.
Wow. So digital isn't just an add-on. It's core to how they operate.
It's absolutely fundamental. It proves digital excellence isn't just for the giant banks.
They also talk about this anchor bank strategy. What exactly is that?
Yeah, the anchor bank positioning idea. It's basically about becoming the main go-to bank for their customers, not just holding their savings account, but being their primary financial partner.
So cross-selling.
Exactly. Offering multiple products together, maybe a pre-approved business loan alongside their current account, or suggesting a gold loan, a two-wheeler loan, even health insurance. The goal is to deepen that relationship, get more services used by each customer, and basically capture a bigger slice of their financial life. It makes customers stickier.
Makes sense. And looking forward, they've put some clear targets out there for the full financial year, FY26.
They have pretty ambitious ones, too.
They're aiming for AUM growth around 20%, deposit growth between 18% and 20%, and a strong PAT growth, profit after tax growth, of about 30%.
30% PAT growth is definitely ambitious.
Plus, they're targeting return on assets, ROA, between 1.6% and 2.0%, and return on equity, ROE, between 15% and 18%.
Those are strong targets. But, they do seem aligned with the strategic shifts we've been talking about, the move to secured assets, the digital strength, focusing on those growth segments. It shows management is confident they can execute.
Right. So wrapping this up, we've taken a really good look under the hood at Jana Small Finance Bank's Q1 FY26. We've seen how they're strategically positioning themselves. It's not just about resilient profit, but that very clear, deliberate shift towards secured lending.
Yeah, underpinned by that impressive digital adoption, and all while they're setting their sights on that bigger future as a potential universal bank.
The bank often emphasizes serving aspirational India, focusing on the underserved. It's central to who they are.
It is, and that really brings up a fascinating question for you, the listener, to think about. As all banks, traditional ones and these small finance banks, continue to evolve and embrace digital tech so rapidly, what does the future actually hold for financial inclusion, for access to credit, for these really vital, growing parts of the economy? What stands out to you as maybe the biggest challenge or the biggest opportunity in this really dynamic and important space?